On the demand side, financial liberalisation starting in the 1980s has given more Australians households access to credit, including for mortgages to finance the acquisition of real estate. So while it's true that the average mortgage is much greater as a share of the household income than it used to be, access to capital, going along to the bank manager, as it was, it's far more readily available today than it used to be. Currently, the RBA's catch rate is at an historic low, and mortgage interest rate is at its lowest point since the 1960s, and many banks offer substantial discounts to that rate. There is no doubt that the availability of credit has made it easy to invest in residential property post the GFC. But to imply that a credit-fueled, investor-speculated housing bubble is the main driver of house prices is an overly simplistic conclusion. For this to be true, house prices need to have moved by more than some conception of fundamental value. It is only in this case where the overall market is at risk of a severe correction. This is one of the key differences between what is happening in Australia and what has happened in other countries that have experienced difficulties in their housing markets. The increase in Australian housing prices, as I've said, has been largely driven by fundamental determinants. It has also not been accompanied by the more lax regulation and lending standards witnessed in other countries. Australia had a comparable run-up in dwelling prices to the US in the early 2000s, but there were some key differences. In Australia, our banks applied stricter lending standards than their American counterparts, with fewer low doc or subprime loans. Further, unlike in many parts of the US, our lending is based on full recourse financing, so the borrowers just can't walk away from their loans and throw their keys in the door and walk away. That's not how our market operates, and that has a fundamental impact on the strength of our markets. So aided by these measures here in Australia, prices did not fall significantly during the financial crisis. Risks around oversupply and inner-city apartment markets have received increasing attention in recent times, and where the number of new dwellings due to be constructed over the next couple of years appears quite large as a share of the existing dwelling stock. But this has raised the prospect of the risk of settlement failures around some new property developments in these areas as the increased supply weighs on property prices. Now, this is an area that both the banks and the authorities are aware of and are taking actions to mitigate. As the RBA has noted, banks have already taken steps to tighten lending standards and collateral requirements for higher density residential projects, which will help forestall future oversupply in some inner city areas. To date, settlement failures remain extremely low, and oversupply in Australia is limited to a number of discrete submarkets in the apartment sector. But that doesn't mean you can be complacent. It doesn't mean there are signs there that you need to pay attention to, as the government is and the regulators are. Policymakers are very cognizant of the risks and have been doing something about it. The intensity of potential regulation of the mortgage sector has increased markedly in recent years, which should help guard against a systematic deterioration in lending standards. In particular, you'd all be aware that APRA announced in December 2014 that will further increase its supervisory intensity, increasing reported obligations on site visits, and may require banks to hold extra capital if they fail to limit investor growth to 10%. And impose minimum standards on a borrower's capacity to meet higher repayments and wind back on high-risk lending practices such as an excess of interest-only loans or too many loans at high loan-to-income and loan-to-value or LVR ratios. Now, largely as a result of these measures, investor credit growth has slowed from 10.8% in May of 2015 to less than 5% at 4.6% in August of this year. This measured approach, this calibrated approach by APRA to cool investor activity is far more preferable response compared to the sledgehammer of abolishing negative gearing. Indicators of the quality of credit being extended in the mortgage market have been improved. The proportion of loans made at the highest loan-to-value ratios has declined. Low doc loans have dwindled to an insignificant proportion of bank lending, and new interest-only lending to owner-occupiers has declined sharply. This calibrated response is the way you deal with these issues. Imagine, as you look at those charts and you see the movement of such a finely calibrated measure, imagine if Bill Shorten and Chris Bowen had got the negative gearing sledgehammer out and applied it to our markets. Now, this has been achieved with what has been implemented without undermining the housing market and the value of Australia's investments in their own home, like those policies which I've just referred to. In addition, Australian banks themselves, to a certain extent, have also tightened lending standards independent of some of these regulatory measures, and we welcome those developments. Of course, house prices and home ownership, though, as I conclude, are only one part of this puzzle of the Australian housing market. Today, I've only had the time to address some of the issues and forces impacting on the home buying side of our markets that we will have to address in the months and years ahead. On another opportunity, I'll lay out how these pressures in the home purchase market are flowing onto the rental sector and indeed the social housing sector as well, and the increasing pressures that are being placed on social and affordable housing programs. You know, we spend around $11 billion a year between Commonwealth and state governments dealing with housing needs in this country. $11 billion every single year. And I don't think there's a person who can put their hand down their heart around the country and say we're getting good value for money on that. And that's a challenge for all state and territory and Commonwealth governments to rectify that situation. So I want to reiterate in closing that the Turnbull government's commitment to getting on with the job of helping more Australians into their own homes. We do not achieve that goal by embarking upon policies that will hit the housing market, lessening the value of assets that Australians rely upon, as our opponents would do with their effective abolition of negative gearing. Instead, we must understand the core drivers of our housing market and, armed with that knowledge, some of which I've outlined to you today, lift more Australians into the market by way of effective policies that better improve housing outcomes. And I look forward to working with all of my ministerial colleagues, state and territory colleagues, and of course the housing and development industry and those who work in the social housing sector to try and achieve all of these outcomes. I think we share the ambition. We celebrate the aspiration of home ownership in this country. We celebrate it. But as time goes on, it's getting harder, and so we have to work harder to get the right outcomes that Australians expect. Thanks for your attention.